Look, the Federal Reserve just cut interest rates. This is huge. It impacts your mortgage. It impacts your savings. Every dollar in your pocket changes right now. Nobody's talking about the real reason. They're trying to dodge a recession. They want to boost jobs. It's a massive move. Here's what's wild. They're playing this hand from a position of strength. They just got incredible news. The banking system is stable. You won't believe, let me be direct. The Federal Reserve just announced rate cuts. This move aims to boost jobs. It prevents recession. Gonzaga University reported this. The Fed is stimulating the economy right now. This is a powerful signal. But here's the thing. They're making this aggressive move. It comes from unexpected strength. The Federal Reserve released annual stress test results. That was just this past Wednesday. These tests check big banks. Can they survive severe economic downturns? And get this. All 32 largest U.S. banks passed. They passed with flying colors. Now pay attention. These stress tests weren't easy. The hypothetical scenario included unemployment surging. It hit a brutal 10%. Commercial real estate prices dropped. That was a staggering 39%. Home prices also declined by 30%. Despite this nightmare, banks could absorb over $708 billion in losses. That's a massive number. Projected losses broke down. Roughly $200 billion came from credit cards. $160 billion was from commercial and industrial loans. $75 billion came from commercial real estate. The industry's common equity Tier 1 capital ratio fell. This is a critical measure of a bank's core capital. It absorbs losses. The ratio fell only 1.6 percentage points. It remained comfortably above required minimums. Federal Reserve Vice Chair for Supervision Michelle Bowman stated, "Today's results underscore the strength of the banking system. This confidence aids Fed rate cuts. However, here's a twist. These results won't affect capital requirements. Not for large banks until 2027. The Fed is reworking its methodology." This followed industry complaints. Analysts at KBW, led by Christopher McGrady, called this year's exercise going through the motions. Banks are currently focused elsewhere. They eye the upcoming Basel III Endgame proposal. Morgan Stanley, Citigroup, Citizens Financial, and KeyCorp would have seen larger capital buffer reductions. That's if these results had counted. And get this, while the Fed maneuvers traditional finance, another massive shift is underway. Asset management giant Invesco just filed with the SEC. It's launching a groundbreaking tokenized fund. The Invesco Stablecoin Reserves on-chain fund targets the rapidly growing stablecoin market. Stablecoins are cryptocurrencies. They maintain a stable value. Often, they peg to fiat currencies like the US dollar. This new fund is a tokenized vehicle. Its ownership is represented by digital tokens. These tokens live on a public blockchain. The fund will invest in cash. It also buys short-term U.S. treasuries. These investments will back stablecoins. They ensure stability. Invesco has over $2.5 trillion in assets under management, and this move isn't just a side project. It is a calculated play for dominance in a market that is evolving at breakneck speed. To understand why a giant like Invesco is pivoting toward the blockchain, we have to look at now. Some of you are probably thinking that we have seen this movie before. Whenever a new financial technology emerges, the skeptics call it a bubble. If we look back at the dot-com boom of the late 90s, the pattern looks similar. We had massive capital inflows and a rush to integrate a new technology into every business model, which eventually led to a spectacular crash. Then you have the 2008 financial crisis, where complex derivatives were marketed as revolutionary tools for risk management, only to trigger a global meltdown. In both cases, the common thread was a lack of transparency and an overestimation of stability. That is what is the same here. The hype is immense, and the speed of adoption is dizzying. However, this time is genuinely different because of the underlying architecture. In 2008, the risk was hidden in opaque bundles of subprime mortgages. Today, tokenization allows for real-time auditing on a public blockchain. The transparency is baked into the code. Unlike the dot-com era, where many companies had no actual revenue, these tokenized funds are backed by the safest assets on Earth, like U.S. Treasuries. We are not betting on a dream. We are upgrading the delivery system of the global reserve currency. We are moving from a system of trust based on a bank's promise to a system of truth based on cryptographic proof. This isn't just a new product. It is a total overhaul of how ownership is recorded and transferred. The risk has shifted from systemic opacity to technical execution. We are seeing the institutionalization of a technology that was once the enemy of the establishment. Now that the foundation is set and the players are in place, it is time to look at the actual data. I'm going to get into the real numbers next. Here is what the data actually shows. When we look at the Federal Reserve's latest stress tests, most people do not realize that these losses are not spread evenly across the board. The projected losses are concentrated, roughly $200 billion tied to credit cards, $160 billion from commercial and industrial loans, and $75 billion from commercial real estate. When you see those figures, the instinct is to panic about the commercial sector, but the data suggests the system is built to tank these hits. However, there is a catch. The Fed has decided to leave the stress test buffers untouched until 2027 while they rework the methodology. This means that for now, the results are essentially a dress rehearsal. KBW analysts have even described this year's exercise as simply going through the motions. If these results had actually counted toward capital requirements today, firms like Morgan Stanley, Citigroup, Citizens Financial, and KeyCorp would have seen some of the largest reductions in their capital buffers. This reveals a critical truth. The stability we see on paper is partly because the regulatory goalposts haven't moved yet. We are operating in a grace period. While the banking system is objectively strong, the real test will be whether these banks can maintain those ratios when the Basel III endgame proposals finally force a change in how capital is held. We are seeing a clash between the Fed's desire for stability and the bank's desire for flexibility, and the $708 billion cushion is the only thing keeping the peace while the regulators figure out the new rules of the game. On the bull side, the path to success is clear. If the integration of tokenized funds, like the one Invesco is filing for, scales correctly, we are looking at a massive efficiency gain. The bull case assumes that the stablecoin market, which Citi predicts could reach $4 trillion by 2030, becomes the primary plumbing for global finance. In this scenario, the speed of settlement moves from days to seconds, and the transparency of on-chain registries eliminates the need for expensive intermediaries. If the Federal Reserve successfully cuts rates to boost jobs without sparking a new wave of inflation, the banking system will enter this digital transition from a position of strength, with high capital ratios and low default rates. The result is a modernized financial architecture where the safety of U.S. Treasuries is combined with the velocity of blockchain technology, creating a gold standard for digital assets. The bear case, however, is far more volatile. The danger is that the systemic risk has not disappeared. It has simply migrated. If the commercial real estate crash is worse than the 39% simulated in the stress tests, the $708 billion loss absorption capacity could be eaten away faster than expected. If we see a simultaneous collapse in home prices and a spike in credit card defaults, the banking system could freeze, regardless of the current capital ratios. Furthermore, the push into tokenization introduces technical execution risk. A single smart contract failure or a regulatory crackdown on stablecoin reserves could wipe out billions in value instantly. If the transition from a system of trust to a system of truth is botched, we could face a liquidity crisis that makes 2008 look like a rehearsal. We would be left with a fragmented system where the old guard is too weak to lead and the new guard is too unstable to trust. So which side is right? That depends on what you do with this next. So which side is right? That depends on what you do with this next. The Federal Reserve's move to cut rates, while ostensibly aimed at boosting jobs and preventing a recession, has a very direct, tangible impact on your financial reality right now. For your savings, these rate cuts mean that the attractive yields you might have been earning on high-yield savings accounts could start to dwindle. If your account was paying 4.5%, expect that to drop closer to 3.5% or even 3% over the next few months, making it tougher for your cash to keep pace with inflation. While the stress tests assure us banks can absorb over $708 billion in losses, your FDIC-insured deposits up to $250,000 are explicitly safe, but the purchasing power of those savings is what you need to vigilantly protect. For your portfolio as a long-term investor, lower interest rates typically make equities more appealing by reducing the cost of borrowing for companies and increasing the present value of future earnings. This could provide a tailwind for your stock holdings, especially in growth-oriented sectors like technology. However, if these rate cuts signal a deeper underlying economic weakness, your portfolio could still face headwinds. Consider rebalancing your bond allocation. Existing bonds might see price appreciation as new bond yields fall, but new investments will yield less. For your short-term trading strategy, expect increased market volatility. The potential 39% drop in commercial real estate prices identified in the stress tests could create specific shorting opportunities or, conversely, highly speculative buying opportunities in deeply discounted REITs or property-related assets if you're willing to take on significant risk. The tokenization trend, with firms like Invesco eyeing a $4 trillion stablecoin market, presents high-yield but high-risk avenues. A tokenized fund might offer 5 to 7% yields, but understanding the underlying smart contract and regulatory risks is paramount. Finally, for your income and job security, the Fed's aim is to prevent unemployment from hitting that stress test scenario of 10%. If they succeed, your job security might remain stable. But if they fail, your income stream could be at risk, emphasizing the need for robust financial planning. Here's your 90-day now. Here are 3 crucial indicators to watch in the next 90 days. If the official unemployment rate rises above 4.5% in any of the next 3 monthly reports, that is your signal to tighten discretionary spending and reassess your personal job security. Second, monitor major commercial real estate indices or local property market reports. If commercial real estate prices decline by another 5% or more from their current levels within the next 90 days, that is your signal to reduce your exposure to regional bank stocks and directly held CRE investments. Finally, watch the 10-year minus 3-month Treasury yield spread, a crucial recession indicator. If the yield curve inversion deepens to minus 100 basis points, or negative 1%, that is your signal to increase your defensive allocations, such as cash or very short-term bonds, and prepare for heightened market volatility. The big picture is coming up next. The Federal Reserve's decision to cut rates in 2026, as reported by Gonzaga University, might seem like a green light for some, but for the discerning investor, it paints a far more nuanced picture of our economic trajectory. This isn't just about boosting jobs. It's a preemptive strike against a looming recession, an acknowledgement of significant underlying fragility in the system. When the Fed pivots from fighting inflation to stimulating growth, it usually signals we are firmly in the late cycle phase, or perhaps even teetering on the brink of an official downturn. The market has likely already absorbed a good portion of this uncertainty, but the full impact of previous tightening cycles and current headwinds often takes time to materialize. What this tells us is that the soft landing narrative is under immense pressure. The Fed is reacting to real-time data, perhaps slowing job creation, softening consumer demand, or early signs of corporate earnings weakness, and attempting to inject liquidity. This isn't a sign of robust health. It's an emergency shot in the arm. My bold prediction is this. Despite the Fed's intervention, we will see a mild, but noticeable economic recession begin within the next 6 to 9 months. The cumulative effect of higher rates over the past few years, coupled with persistent geopolitical tensions and the slow-motion crisis in commercial real estate, creates too much drag for a single rate cut to overcome instantly. Most people will interpret this rate cut as an immediate, all-clear signal, missing the crucial point that the market often continues its descent after the initial rate cut. Smart money understands that the Fed reacts to problems. It doesn't magically make them disappear overnight. This period, while challenging, will ultimately present unparalleled opportunities for those who understand the true rhythm of the market cycle and are prepared to act when the true bottom emerges. So, to quickly recap what we've covered today, the Fed's rate cut, while intended to boost the economy, highlights a period of significant fragility, signaling we are deep in the late market cycle. We discussed the critical importance of monitoring your personal spending and job security, watching for further declines in commercial real estate prices, and paying close attention to the deepening inversion of the 10-year minus 3-month Treasury yield spread. These are your essential signals to adjust your portfolios, increase defensive allocations, and prepare for what promises to be a highly volatile period ahead. The next 90 days are going to be critical. The confluence of these indicators will provide undeniable clarity on the path forward, shaping investment decisions for months to come. Stay vigilant, stay informed, and most importantly, stay strategic with your capital. If you found this breakdown valuable, subscribe. We drop new finance videos every day. And watch our other videos to stay ahead of the market. Follow for more information.